Okay, so exchange rate calculations. So today, broadly, the topic is very limited, but a very important topic, a little tricky as well, where we'll teach you certain important concepts around what is currency cross rate. Okay, so exchange rate, we look at cross rates for foreign currency, and a very critical concept in the world of arbitrage, where we look at spot and forward rates, right? How do we measure the spot rate and the rate in the future, the forward rate, by using arbitrage theory? Now, here we can use either a point system or a percentage system. Okay, and using point percentage, we can actually find out how many points or how much percentage the rate is going to be ahead or backward in the future. Here. So quickly before we go to that, what exactly is an exchange rate? You know, as an exchange rate, it's basically by say $1 equals to around 92 today. So that's the rate of exchange between a dollar and a rupee, right? Now, a cross rate is a rate where I try to use two different currencies to derive a third currency. Example, if I know that $1 is 92 rupees, and I also know that $1 is around 0.9 to the pound, because you know the pound is stronger. So $1 is only 0.9 to the pound. That means by using these two rates, can I cut down and find out what is the rate of rupee to the pound? I can do that, right? I can use dollar rate rupee, dollar rate pound, and use these two to derive the implied rate between the rupee and the pound. Now, this obviously is not required because rupee to the pound is already available. So when you use this rate, we use this rate when we do not have the direct exchange rate between a certain country. So let's say example, you don't know what the rate between India and Zimbabwe. पता नहीं. But मुझे डॉलर जिम्बाब्वे का रेट पता है, डॉलर इंडिया का रेट पता है. So I can find the implied rate of the rupee Zimbabwe. Is that clear? So cross rate helps you find out rate with a common third currency when the direct rate is not available, when there's no direct or actively traded forex. समझा? All I have to do is use a third currency and do it. Obviously, the implied rate which is computed should be consistent. नहीं तो you'll have arbitrage. अगर वो rate नहीं चला, if the cross rate does not work, then you'll have opportunity. Clear? So got this logic? If I say $1 so $1 so much, that means if I do rupee to pound, I'll effectively get that 1 pound is approximately 100 rupees to this relationship. Correct? And this has to hold true, otherwise this will end up in an arbitrage. Clear? So I'm using two rates with a common denomination to derive an implied rate between the other two currencies. Clear? Don't run to find any formula, concepts, logically yaad rakhna how to get this answer. Clear? We'll look at an example for this. In the exam, they'll always give you a very random third currency. Like see here they get pesos of Mexico and they give Australian dollars, right? And they're asking you with regard to US dollars. So remember, they'll randomly place any two currencies. So now they're asking you what is the implied rate between the peso and the dollar. Now don't bother what's the names. Assume chalo peso Mexican hoga. They want to tell what is the relation between Mexican pesos and Australian dollars using the Mexican US dollar and the Australian US dollar currency. Clear? Now you have to be very careful. You have to do something like a denominator exchange. Example, you know that A upon B into B upon A will cancel, right? Right or wrong? So you have to find out, obviously, B upon C will give A upon C. So B cancel, but you can't do divide by B upon C, then B square नीचे आएगा. So you have to think कि कौन सा ऊपर है, कौन सा नीचे है, किसको eliminate करने का है. The one that you eliminate should be eliminated in this method. Is that clear? So quickly, let's look at this example. I am saying Mexican upon dollar. And यहाँ पे I can see dollar upon Australian. So यहाँ पे dollar upon Australian dollar है. और मुझे चाहिए क्या? What do I want? I want Mexican upon Australian, right? See, they're giving you. So simple. Look at this and tell me how to get this equation. If you're on this equation, you have to multiply so that this gets cut and this remains, and that's your answer. So whatever they ask you, use these numbers to derive that answer. Is that clear? Now suppose they ask you Australian dollar to Mexican, then you say fine. You get the answer and then you do the inverse. You can do 1 upon Mexican by Australian. Uska ulta kiya to Australian dollar to Mexican. Is that clear? So learn how to eliminate the common number. Had you done divide by this and this, then the answer will be wrong. The dollar will come down and eliminate neutral. Clear? So learn what to eliminate and how to form the equation. So you agree with that answer that I should do? First you write this Mexican dollar dollar. Okay, acha multiply karna hai, cancel. Then you do 10.7 into 0.6. And that's your exam answer. Some people by mistake they do 10.7 divided by 0.6. Wrong answer. It has to be 10.7 into 0.6 because only then the dollar cancels and you're left with Mexican upon Australian. Here, what is 6.42? It is Mexican peso to $2. So it is how much pesos you have to pay per Australian dollar. Here, how much pesos per Australian dollar. So don't just learn the formula and the sum solving, learn the interpretation also. So cross trace is done by common this. Okay. Here, this was a fairly simple one because they gave you in straightforward. But let's say I give you Mexican to dollar and I give you Australian to the dollar. I give you these two and I am saying find out for me Mexican to Australian dollar. So kya karo? What to do? Simple. Either you take this number and you divide by this number, correct? Right or wrong? Because then when you divide it's the same thing as doing into dollar per Australian. So divide by this number or you take the inverse of this number to dollar Australian. If you multiply them. Got it? So learn that you have to get this answer by hook or by crook. You have to play with these numbers and cancel the dollars and leave only Mexican to Australian dollar pending. Clear? Any questions? Okay. So this is very critical. I'll do one more illustration later. You guys tell me what do you think is the answer in this case? Solve this for me, this one. I'm giving you the Swiss franc to the dollar rate. I'm giving you the New Zealand dollar to dollar. We यहाँ पे दोनों denominator में. And understand what they're asking you. They don't want New Zealand dollar to Swiss franc. They want Swiss franc to New Zealand dollars. So they are saying, what is the Swiss franc rate upon the New Zealand dollar rate? ये बात है क्या? CHF per dollar, NZD per dollar. How to get CHF per NZD? Answer. Should I multiply? Should I divide? Answer guys. Multiply or divide? I have this, I have this. What to do? Answer online? No idea? Hello? So because you want CHF per New Zealand, you take CHF per dollar and you divide it by the dollar, the New Zealand per dollar. उससे क्या होगा? This will go up when you multiply, cancels, as will come down. So the final answer is CHF per New Zealand dollar. Clear? So this division or multiplication itself is a tough decision to make. So that means you'll do CHF dollar 1.699, New Zealand dollar to dollar 2 points. So this divided by this is the answer. Don't try to be emotional, but I have to divide new with that. It can be big or small. You look at the maths. You first do the maths and then you take the numbers and you get the answer. So you see the answer will come in something point, 0 point something, but that's okay. Clear? The answer is this divided by this. Easy so far? That's critical. Any questions? Let's come to the concept of arbitrage. Now, arbitrage concept relationship is only to find out, okay, what is the market rates so that no one is allowed to earn arbitrage profits. Now, what is no arbitrage? It means there is no free profits. मतलब फुक्कट का किसी को प्रॉफिट नहीं कमाना चाहिए. If there are free profits, then that means an arbitrage opportunity. If arbitrage opportunity is there, it will become eliminated in within a few minutes because no one is allowed to earn free profits. Clear? Now let's understand how it applies to currencies, right? Arbitrage, the concept, is helping you to find out what is the forward rate and the spot rate. Okay. Now exchange rate, example, let's take today $1 is equal to rupees 92. Okay. Now in the future, let's say after 1 year, $1 might be equal to how much? Rupees, I don't know. But I do know that there's a forward rate in the market. Forward rate is available. So they'll say, अच्छा, 1 year के हिसाब से, forward rate say after 1 year, I will give you $1 का 94 rupees maybe. तो ये forward rate चलता होगा, ठीक है? Maybe OF 94. So you will wonder if there's a forward rate of 94, right? You will immediately look for an arbitrage opportunity. How to find that? How to look at that? For the purpose of riskless, you're not putting your own capital. You're going to borrow. So you have to do two things. Find out what is the interest rate in the two countries, in USA and India. Let's say in USA, the interest rate is 4%, right? And in India, the exchange rate, everyone knows 7%. Okay? So you need to look at this and then decide कि भाई forward rate कितना होना चाहिए. Clear? Now, the mechanism is this. There are 4 steps. Okay, what are 4 steps? 1, borrow currency, any currency. You can say currency A. So borrow, let's say dollars at interest rate of $1. Use that money to invest in the rupees at the current exchange rate. Clear? काम खत्म हो गया. तूने borrow किया और उसको invest किया. तूने अपना rate लॉक कर दिया. But invest करने के बाद you are going to, convert it, you are going to invest. So you will borrow and convert it and then invest it. Now remember, once you invest it, you have to ensure that you are protected by the exchange rate. So you'll also sell the forward rate, okay, a forward contract. Now wait for 1 year. After 1 year, what do you do? The amount you invested, you will get it back with interest. That amount you will convert it into the dollar component, and that you will use to repay the loan of currency. So you invested more money, you deposited more money, you took more money. All you did is you borrowed, invested, sold, repaid. So जेब से 8 पैसा नहीं गया. If that is to happen, then the rate of forward should have been riskless. तुझे कोई प्रॉफिट कमाने का चांस नहीं मिला चाहिए, कुछ risk लिया नहीं है. You not put any money in that. How do you do it? This is how it goes. Okay. So what do you do? Borrow currency A. So you probably say, let me buy. Okay. Let me buy. Just an example. Let's say $1,000. Right. Okay. At 92. So when you buy $1,000, what are you paying effectively? You're paying the rupees, right? So borrow the amount at rate, right? So you tell your bank, give me a loan. Okay, so this is a loan of $1,000. The bank will charge interest. This loan, you will go and invest in rupees. This will convert into how much rupees? 92,000 rupees. And this 9,000 rupees you will invest at what rate of interest? At the Indian rate of interest. So you will invest it at 7%. Now, if your loan to India, this loan you're paying 4%, right? And this investment you're earning 7%, right? After say 1 year, you earn 7% 90,000. So कितना मिला? What you received? Check. You invested 90,000, you got 7%. How much will you receive? Answer. Answer, guys. 963. 64,000. So you receive 90,400 rupees. Okay. This you will now convert to dollars. Right? अब इसको कन्वर्ट करने के तुम डॉलर पे कौन से रेट पे तुमने ऑलरेडी ये बेच दिया, राइट? यू ओनली इनटू 94, सो यू विल से बॉस मुझे 94 का रेट चाहिए, करेक्ट? When you convert 94, you will get how much? You will get approximately 94, 1,000, maybe 1,050 dollars, right? Now that dollar you will take and go to your bank and say, boss, मैंने जैसे loan लिया, take the loan back, take the interest. So when you repay the loan, you will have to repay not just $1,000, but you'll also repay 4%, which is $40. 1,040. So now look, you earned 1,050, but you're paying only 1,040. This 1,000 plus 40. Nothing else. So only see you're getting $10 fukad ka. 10 क्या इन्हें स्पाइरल्स होता तो कर लेता. I could made some $1 million contract in this. अगर 5 ही मिलता तो $5 million. So this can never rise. Even one extra rupee cannot count. This amount should be equal to this amount. Here I probably showed you that an arbitrage opportunity existing because this amount is 1,050 and this amount coming to 1,040. So whenever the implied rate and the actual rate are not the same, the average profit. If it's lower, you will buy. If it's higher, you will sell. So in this video, you understand what is arbitrage profit. Look again at the example. Borrow currency A, $1,000. Convert to currency B, 90,000 rupees. Invest 9,000 rupees and earn 7%. Right? Paisa mil gaya. Now you have to convert it back into dollars. For that, you are selling future forward rate, and the forex rate will not correct because remember the rate that you agreed to, that's the forward rate of future rate. That rate will always be confirmed. Once you get the rate, get the amount, earn the differential, and then you're sorted. Clear? So learn the mechanics. This is the sum I showed you, and proof that this price should be equal to this price. That's it. Any questions? No arbitrage conditions. Yeah. Now, this phenomenon I explained to you will help you understand how to compute the forward rate, right? So now you answer by all this that boss ये तो हो ही नहीं सकता कि $10 नुकसान हो. So therefore, we now understand that this concept is going to help me to find out the forward rate. Now you already understand the forward rate, nothing but a function of my interest rate of the two different countries, right? So this is a very important learning where we say, therefore, okay, now better equation is this. The forward rate is nothing but the spot rate into 1 plus R upon 1 plus R. Here, now if you remember last night I taught you a very important concept. तुम कौन सा R लोगे, right? Base price currency. So let's put like this. If the forward rate is based on domestic to foreign, then you will take domestic ऊपर है तो domestic, foreign नीचे है तो foreign. So forward rate is nothing but spot rate into 1 plus domestic R, 1 plus foreign. The यहाँ पे लोगों ने उल्टा किया. They said correct. Forward rate equal to, if you take this side, spot into 1 plus R, which also means that forward upon spot is equal to 1 plus R upon 1 plus R, the ratio of the rates of the two different countries. Clear? Very important learning. So don't forget this. Spot forward को कैसे करो? Spot को multiply करो into 1 plus R, 1 plus R, D ऊपर F नीचे, because that's a currency. अगर मैंने ऊपर F लिया नीचे D लिया तो यहाँ पे F लो यहाँ पे D लो. Whatever comes here first, will come here. What comes here will come here. Are we clear? So in the exam, don't think, what is domestic, what is foreign, what is base, what is price? No, you are simply aware that if I take spot D upon F, D can be anything. D upon F नीचे आएगा. If I take spot dollar upon pound, don't care what dollar is, just take dollar up, pound down. Whatever is up down here, that will go up. That's it. That's as simple as it gets. Any questions? Very important formula. Okay, and this formula is based on the no riskless arbitrage opportunity. No risk. So basically, I want no one to earn profits without taking risk. Clear formula यहाँ पे समझा है. Clear? Okay. Now this will also help you to find out what a forward rate. Okay. Now if I tell you, अभी तो तूने formula सीख लिया कि for a spot into मैंने spot लिया. There's another way to find out a way to compute forward rate by using two mechanisms. One is point system and the other is percentage system. Now what is point and percentage system? Very simple, honestly. Point में मैं बोलता हूँ कि कितना point ऊपर है, नहीं the answer. Percentage is how much percentage. So you all have to tell you is, if the spot is let's say 100 rupees, I say it will go up by 10 points. That means you have to add 10 points to 100. If I say it will go up by 10%, you have to add this percentage to 100. Clear? Now let's learn a very important thing here. Okay, what is 1 point? Now 1 point here refers to 1 basis point. BP. BP is not blood pressure. BP is basis point. What is 1 basis point? 1 basis point is equal to what? 0.01 percentage. Now how to remember this? Remember, every week, every time the RBI meets, what they say? They say that we will look at 100 basis points or maybe 25 basis points is what they do. So every time they look at whether I'm able to, what is the interest rate? So 100 basis points is 1%. 25 basis points is 0.25%. So learn this well, because now we will convert it into hundreds. So it is 0.01%. It's nothing but 0.01 upon 100. 100 cut, tuck, tuck. So it is 0.0001. Yeah. Same here. What is 0.25%? It's 0.0025. Yeah. So understand, obviously another shortcut is what is 0.001? It's 1 upon 10,000. Yeah. But you should learn this difference. It comes in some sort. So what is 25 basis points? What is 5 basis points? What is 10 basis points? So basis points, nothing but amount divided by 10,000, because you are exactly divided by 10,000, right? Amount divided by 10,000 basis points. And that's how you think. Here. So if I give you a quotation, okay, if I tell you the quotation is 18.3 basis points. What is 18.3? 18.3 is, remember I told you, 0.183. What? Percentage. Which means it is 0.00183. That's all. So अगर आज rate है, let's say 7, then the answer will come to 7.0018. Are you clear? So this basis points के हिसाब से अगर मैं तुझे बोला कि आगे का रेट कम या ज्यादा रहेगा, तो तुझे ये करना है और उसको ऐड ये करना है या माइनस करना है. That is called using the point system. Okay. Now percentage is fairly simple. वो तो तुम लोग जानते हो. In the percentage system, I will look at not the points but the percentage. Okay. Example. They are saying कि rate तो अभी इतना है, but forward rate आगे जाके इतना होने वाला है, गिरने वाला है. So you say fine, 0.7313 है ना अभी, इतना गिरेगा, correct? So कितना हो जाएगा अगर मैंने इसमें से 0.00062 करेक्ट परसेंटेज हरा दिया तो कितना होगा. सो इसमें से ये निकल कितना होगा, और यू कैन डू लाइक दिस. This is the amount. How much will remain? 1 minus the above number. Yeah. This is using the percentage system. Now in points, there's no need to do 1 minus and percentage, right? All you have to do is take the number and add it. You have this rate 3.5, so 0.7313. You're adding 3.5 basis points, so you're adding 3.5, right? Now here, 0.035, right? But 0.035 को वापस करो divide 100 से, then you get the answer 0.1, 3.5, 0.035 or 0.0003. So 0.035 percentage, right? Which is also equal to 0.00035. Here, 1, 2, 1, 2. Here, this amount, what you do? This is nothing but the change. So that change you will add it to this amount. So you do 0.7313. That's 0.00035. Here. So when I ask you to find the forward rate in percentage system, you will take percentage to 1 minus. When I say to find the point system, simply take the number and add the points to that. Here, and you'll get a forward exchange rate. Okay, can you guys quickly just check this? Practice it, break it for 2 minutes, very important. How to arrive at the revised price. Any questions? So we learned how to compute forward rate using points and percentage, right? And this is a quick summary of what we have just discussed in that. So I taught you that I can quote it in points, percentage quotes, but percentage quotes are more useful and better because you can interpret it also carefully. Okay. Now find a relationship. Now you know that the forward rate is higher or lower. It depends. How to find out how much higher or low? Simple. Take the rate in the next period, divide the rate in the current period, you get a percent increase. Example, let's say the next period rate is, let's say, 110. Current period is 100. So you know the answer. It is 10% increase. If I do future rate upon my current rate -1, I'll get 10%. So simple. Answer मिल गया ना? So if I take the rate in the future, rate on today -1, I will get the percentage change in the stock in the period after price. Second way to get it is by using the differential, because it's called, learn this carefully, interest rate differential, where we conclude that the difference in the interest rate is the reason for the increase or decrease in the currency. So I say fine, वो difference उसको ले ले, but the difference in the futures and discounted price rate. Right? So there are two ways. Find the future price upon today's price -1, or find the interest rate differential upon 1 plus RT. That's it. Clear? Any questions? Okay. Now this is important interpretation. If when you do all this, the appreciation will happen or depreciation. Now, interest rate, if the interest rate is higher, right? An increase in a country interest rate will obviously attract more people to invest because the interest is higher. So more people will invest, and in that case, the domestic currency will lead to an appreciation. Got it? So whenever, let's say India ने बोला interest rate बढ़ा नहीं है, it's a good news because अपना country का currency will go up, will appreciate. Appreciate means the rate will come down. I hope you understand that. If I'm paying less rupees, that means my rate will appreciate. So this is important. Okay. And similarly, when the no arbitrage rule, what we say? But here we say higher interest rate leads to higher interest. So in this formula, if you notice, we are actually saying जितना ज़्यादा interest rate है, उतना ज़्यादा the country's rate will appreciate. That is wrong theory as per the economics. So economics says higher interest rate leads to a higher appreciation. But economics says a higher interest rate will lead to a higher depreciation. And what's the rate of change in currency? That's nothing but the difference in the two rates of country. So if India is 7%, US is 4%, the 3% differential will reflect in the future exchange rate. Clear? Interest rate differential. So they are predictors. No, they may be poor, but they are predictors. And the no arbitrage says that the rate that prevents, I want a rate that prevents currency arbitrage. At any point, that rate should be continuing because that rate is the no arbitrage rate. Clear? Any questions? Right? So we learned how the arbitrage theory will always work and the rate will always be equal to that difference, right? How will you interpret it? Like this. Now you tell me, spot rate itna hai, spot rate itna hai. Has the currency appreciated or depreciated? If the dollar is paying $1.3 for 1 euro and now it's having to pay more dollar per euro, what is the meaning? The dollar has depreciated because it was paying only 1.3, now it's paying 1.32. It's paying more dollars for the euro. That means the rate has effectively depreciated, correct? For the dollar. But the rate has appreciated for the euro. So when I tell you what is a euro premium or appreciation, you do like this. For upon spot. This is the euro ka premium. If the dollar has depreciated, that means the euro has appreciated better. Correct? And that's the way to get the formula. अगर मुझे यूरो के हिसाब से फॉरवर्ड स्पॉट करना है तो I'll get appreciation. If I do dollar के हिसाब से I'll get the depreciation, right? Because the value is positive, obviously it's positive. So the euro is trading at a good rate forward. Clear? And also if the rate is for a certain time period, 90 days है, then you can take it for the 12-month period and analyze it. Okay? Suppose the forward rate, अभी यहाँ पे जो rate premium, अगर वो forward rate discount पे हुआ, negative हुआ, मतलब it is on a discount. Is that possible? Yes, it is possible. कि forward में rate discount होगा, appreciate होगा, depreciate होगा, all possibility are there. You have to understand how powerful that stands. Any questions? So this is on rate. Forward discount is at a premium or at a discount. Yeah. Find out through. Here. At a premium or at a discount. Any questions? Very important interpretation. Okay. Let's do the question now quickly. As we always do, take 2-3 minutes, guys. Go through questions and then we'll answer them together. Come on, online people, please address it. These are simple sums and computation. I want the cross rate, and here I want the exchange rate using the no arbitrage principle. Cross rate is simple, so that for the answer.
Question 1 is A.
A, okay, very good. Question 1 is A. Question B, 2. Just do 1 and 2 for now. Other people can also answer. Question 1, question 2. Question 2, guys, also answer quickly. Now, let's quickly pick up. You're given IDR dollar, right? So I upon dollar. And you're given New Zealand upon dollar. Well, so see what you've been given. And what they asked you, New Zealand upon I, right? So you want this answer. How do you get this answer? N upon dollar is given, I upon dollar, but I want I down, right? So you could do one thing. You could probably inverse this and then multiply, or if I do N upon dollar divided by I upon dollar, correct? Dollar cancels, N upon I remains. So I need to do N upon I. N is 1.6 and I is 2,400. That's the answer. Here, obviously that, and that's right, it comes to E. Here, very good. Let's go to next one. If I have dollar upon N and I have N upon SEK. Oh, this is interesting. Dollar upon N and N upon SEK. And I want dollar upon SEK. Right? So I want dollar upon SEK. Simple. I want this on top, this at the bottom. Perfect bet, right? Cut, multiply. So the answer is 0.35 into 0.31. What is so difficult about it? Correct? Answer is again A. Right or no? Any question on this? Make sense? Who wants to online as well? Right? Now, let us spot rate. This is the points wala system. The spot rate is 1.3050. The exchange rate is minus 42 minus discount. So what's the future rate? Now you know the answer should be something less than 3050, right? It can't be this, galat hai. It can be either this or this. Now it's 42.5 basis points. So 42.5 divided by 10,000, right? 10,000. 1, 2, 3, 4, right? 32. It is 0.00425. इसको तुम ऐड करोगे 1.30506. So you got 1. Sorry, this is minus, my bad. Minus है ना? Minus 5. So 1.050 minus this. So 1.30, right? 5 minus 4 is 1, right? Okay, let's go minus करोगे. So 0. This becomes 10, 8, 5. So 1.30085 is the right answer, which is option number. Clear? So don't think 30 में से 42 उड़ा दिया तो 26 मिलेगा, वो गलत है. You have to think of 0.0004. Okay? Any questions? So this is a very good way to find out using the point system. सबको पता actually तो easy है तो वो शायद कम पूछेंगे. Point system के हिसाब से learn how to solve this. Right? Last two sums start. The current spot rate for GBP. GBP in terms of dollars is how much? So this is in terms of US dollars. So 1.533 dollar per GBP. Correct? Per GBP. So 1 day forward rate, 180 day forward rate is $1.508 per GBP. Right? So what is the meaning of this? The dollar is trading at a discount or a premium. Okay. अभी तुझे पता है कि first find out, is it a discount or premium? First find that out. Now, remember, I'm not asking you for the word appreciation, depreciation. I'm asking for discount or premium. ठीक है? Discount or premium. So you need to follow the formula. What's the formula? I told you S upon S. T plus 1 ऊपर आएगा, T नीचे आएगा, -1. So what is the S in the future? This one. So this divided by 1.533, right? Amount in the future upon the amount today. So this upon this -1 will give you what? It's a smaller number, it's negative, right? What's the answer? Firstly, the negative or positive? It is negative, minus. So that means it's a discount. Kitna discount hai? I think the answer is 1.66%. Check quickly on your calculators, guys. 1.508 divided by 1.533. And then you solve it. -1. You will get the negative sign and potentially the number that's already mentioned separately. Clear? 180 day forward discount. Okay, now last one. The annual interest, this is very interesting. Interest rate is 4 and 7. Forward rate is not given to you, spot rate is given to you. So you know the formula. Forward into spot into 1 plus R upon 1 plus D. Right? Because forward is also based on R by D. So what's the answer? Spot kitna hai? 9.5238. Right? What is the rate? Okay, now the spot is going to be in terms of what? SEK per dollar, right? SEK per dollar. So I'll do into 1 plus rate of SEK and upon 1 plus rate of dollar. For SEK rate 1.04. For the dollar rate 1.07. That's it. Clear? Solve the answer and see what you got. Spot into domestic upon foreign, or you can name it accordingly. See the answer same. This is the implied 1-year forward rate implied for the future. Guys, answer. I should not approach you already. Come on. So the way I got you, you will do this, correct? SEK to the dollar. SEK is the exchange rate. SEK. Oh, okay. Here it is. Dollar is 4% and SEK. So you have to say SEK to the dollar, right? SEK is in fact 4%. So it's 4 and dollar is 7%. Right. So follow the same order, right, that they're doing. So when you compute a forward discount, use the basis points. When you do a percentage, make sure that you're using the seller. Okay. Forward rate is this much into discount rate of the home country upon the fund. Okay. Yeah. Any questions? So very interesting. There are specific connects, but this is a little important. Expect 1 or 2 small questions to come from this topic. Clear? With that, we now wrap up economics. Quite a lot of study. We did micro, we did macro, we did currencies, exchange rate, monetary policy, fiscal policy. Quite a few. Please answer it and study well for the exams. Yeah. Okay. Sure. It's fine. Let's take a quick break now only. So the next part of it, while do derivatives will be no break. We do full-fledged derivatives completely, right? And don't stop there. Little important. Make sure you go through it. Everything carefully. Right, so let's start the next part, guys. The next module, which is derivatives. Okay. I hope many of you all know the concept of what exactly is derivatives and what it means. We'll cover derivative instruments, look at what the derivative market has, the features, commitments in the derivative market, and obviously how it's used to benefit the users and how does it help to mitigate the risk. Okay. Now, before we really go to that, let's understand what exactly is a derivative. Now, a derivative is basically any security, okay, any instrument where the instrument is deriving the value, okay, the security instrument is deriving the value from another instrument, which is also called as underlying, okay. So because that instrument is deriving the value from another instrument, therefore it is called a derivative. Derivative. It is deriving value from another instrument. Clear? Okay. Now quick example. Let's say, how do I explain that to you? Let's say I took a Reliance shares, a Reliance share cup future. Futures is a derivative, right? The future is on Reliance shares, right? And also this futures is, let's say, worth around 1500 because the value of Reliance is also around 1500. So the futures value is 1500 something. Now, if the Reliance shares goes up, then this future, which is a derivative contract, even this value will go up because this contract is dependent on the underlying share. So as this value goes up, this value goes up, this value is derived from this value. So therefore, this is called a derivative of Reliance shares. So I could take derivative of any share. I could take a derivative of futures of anything, Infosys, TCS. Obviously, whatever the underlying, that underlying might go up or down. This futures contract will also go up or down based on the underlying, right? What could the underlying be? Underlying could be anything. It can be even something abstract as the weather. If the rain comes, the value will go up. If the rain doesn't come, goes down. It can be anything. The underlying would normally be stocks, interest rate. Interest rate going up, the value of the contract will go up. The interest rate happen. Thank you. Okay. So the underlying could be equities, it could be shares, it could be indices also. I could take a derivative of the Nifty. The Nifty index going up or down. The bonds, it could be bond indices, it could be interest rates also. It could be commodities also. I could say onions, tomatoes. It could be metals, gold, silver. I could have derivatives on that price. Silver price goes up, the future value. The futures contract depends on the value of the gold and silver, right? All of you are seeing the gold silver crash and happen in the last 2 days. Because the value is going down, the future contract also of the gold and silver is going down because the contract is deriving the value from the underlying instrument. Okay, credit indices, all of these are the part of your derivative, and these are all the examples of underlying on which I can buy a derivative contract. So underlying can be interest rate future, equity future, bond future, and so on. Clear the concept of what exactly is derivative? Now, in the real world, there are many types of derivatives, but from a CFA exam point of view, to understand and to solve, we'll mainly focus on 4 types: forwards, futures, swaps, and options. Bus. This is where you have to learn the mechanism, the solving, maybe of interpretation. And there's a 5th one, which is called credit derivatives, where we'll only understand the concept of credit derivatives, where's the underlying risk, and where they derive the value from. But from a sums point of view, you'll have to understand forwards, futures, swaps, and options. So broadly, the other types of derivative, right? Now, a derivative could be of 2 nature. Okay, it could be a derivative that is traded over the counter. Means over the counter. Counter hai, you're the seller, I'm the buyer, or I'm the seller. I'm giving you over the counter, you take the money. So over the counters, as we're saying, to dukaan pe ja rahe, going to a shop and buying something, that is called over the counter. Obviously, we're going over the counter and trying to negotiate and buy something across the counter. You will be able to customize it. You'll be able to deal with the person directly, right? You'll be paying him cash and taking the goods. You'll not say, "Chalo, difference we manage," right? Obviously, the liquidity is very low, and it is possible that suppose you enter a contract to do something future, that guy may disappear on the day of settlement. So the counterparty risk is very high, right? You're dealing in the dealer's market, obviously, and over the counter is normally not regulated. Who will sit and bother to किसको मिल रहा है, किसके साथ deal कर रहा है? They'll not regulate on that because over the counter, correct? And you cannot deal with a third person. You're dealing with him, you close with the deal with him. There's no other secondary market here, right? Which instruments trade over the counter? Very limited guys, normally customized, so exotic instruments which are meeting your needs. Swaps, forwards. Forward contract are normally over the counter because normally this is always looking at cash settlement. So जो भी cash में settle होगा normally is traded over the counter, right? Even swaps, interest rate swaps, you'll have 2 people who want to enter a swap, but they have to have someone who's in the middle called a banker. So swaps are also done through 2 people over the counter and not through the exchange. Clear? Now, if I don't want to do over the counter, I can simply go to the exchange and just look at what's available and just buy and sell whichever I want. So I could go into a Reliance future on the exchange, see what's available, buy it. Here you cannot sit and customize. Here you can only take what is available. So in an exchange traded platform, I will see what's available and standardized contracts. The exchange is the counterparty. I'm not deal. I don't know who it got sold to. I bought it. I don't know the seller. To me, the exchange is the seller. To the other guy, the exchange is the buyer. Right? Obviously, if I'm doing through exchange, the exchange says, boss, every date will say mark to market. So obviously there's very high liquidity, but the exchange involved, and therefore there is no risk at all because Mera counterparty exchanged it. Correct? It's centralized, obviously it's highly regulated, and they normally have an active secondary market. The most popular ones are futures and options, which we'll cover. Clear? So please guys look at this carefully and understand what's the key difference between exchange traded contracts and over the counter. Take a breath guys. Any doubts you have on these concepts? ETC and OTC. What would you like to trade? Obviously the standard answer, everyone should go for ETC because there's no risk, there's exchange traded and so on. But if you do want to go something that's not standard, that's something more customized you want to do, then you please use the OT counter, but do not do it directly. Try to involve a middleman, like a banker or a broker, someone who makes sure that the deal is not mistaken, is not affected, it will go through. So try to keep a middleman involved to the extent possible. Here, okay. So that's your OTC and ETC. Right? Quickly, we're not done with this. We'll just go to main parts. So that's your derivatives content, derivatives markets, which are following most accurately describe the derivative security, which most closely describes. Does it always increase rate risk? No, it is mitigating risk, right? It's affecting. Does it have no expiration date? No. Every derivative will expire either after 1 month or 2 months or 3 months. Does it have a payoff based on an asset? Yes, it's always deriving its value from another asset and therefore it's called a derivative. Yeah. Which are following is least accurate. Least. So you have to tell me which is accurate first, then you eliminate that and give least accurate. Is exchange contracts liquid? Yes, it can be bought and sold. Are they standardized or customized? They are standardized, not customized. Do they carry significant default risk? No, because they are traded through the exchange, and therefore this is the right answer because that answer is the least accurate answer. Clear? Okay, least accurate. Okay. Now let's quickly look at how the commitments work and what are the features for that. Please understand what the institute expects you guys to know and learn. The learning outcomes is defining what forward contracts are, future contracts, swaps. Now, like I told you, they will mainly make you understand these four very well and obviously know what exactly you mean by derivatives and be able to compare and contrast them. Then they'll ask you sums around valuation from call and put options, how to profit from them, what is the value, what's the profit and loss, and so on. And then we look at the how forward commitments are different from contingent claims. Okay, quickly, what's a forward contract? Now, a forward contract essentially means anything that is contracted for a future commitment, right? When two parties come and say, boss, I want to enter the forward contract. The two parties come together and they commit. What they commit, one will buy, one will sell. They'll deal with one asset at a future date, at a future price. So let's say A and B come together. A will say, I want to buy. B will say, fine, I will sell. What? Let's say Reliance, 100 shares at 1500. So A is telling I will buy Reliance shares 100 at 1500. B will say I'm selling you Reliance shares at 1500. So A will have to pay how much? 1,50,000 and B will have to sell Reliance shares. This is a commitment. Now the Reliance shares becomes 1,600, 700 or 2,000. He cannot say, oh sorry, I'm not back out. He has to sell the shares at 1500 no matter what. Same funda, if Reliance becomes 1400 or 1000 bucks, this guy will make money. But he can't say, no, 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 sorry, I don't know, it's too much. No, he can't do that. He has to buy and he has to sell, and the commitment cannot be backed out. And that is a forward contract. No commitment, no can be broken. Best example of forward contract is farmers, onions, right? A farmer has got crops. Let's say he's got onions. Let's say he's going to cut 100 kg onions from this land. Now he doesn't know that market may boss my onions will be selling for 80 or 90 or maybe 120. I mean, market price will be 120. But what if 120? He said, okay, good, I'll get 12,000 piece. I'm happy. But what if 120 per kg for 100 kg becomes 90? Or market में he doesn't get 90 that much. He gets 90. So he bichara lost 3,000 rupees. Or 80. He lost 4,000. So in order to secure this price, he will go and say, boss, forward contract में मुझे 120 का contract दे दो मुझे. So now he'll hold the other partner to commit that you will take mine at 120, even if the market fails or collapses in the future, you'll still take it at the amount of 120. Clear? Okay. So this is critical. You have to stay committed no matter what, and you can be buyer, seller. Now remember, guys, buy company is long. Sell means short. So I may have a long forward or a short forward. Here, unlike asset, it's at a future date and future price, and both. So future data is certain, future price also certain, but the actual price will never be known in the market, right? So forwards, they're customized, they're always subject to risk. Remember, dealing with the person directly, he may disappear. It's difficult to close out. They carry low liquidity, and they're used by hedgers to ignore the options. Clear? So normally forwards are not speculative. The person with a forward contract is very clear that he wants to mitigate his loss. So it's normally not a speculative contract. So contract to close out his position, hold the position, and close it out on maturity. Yeah. Other contracts we can close it whenever you want. So a person who wants to hold will go forward. A person who wants to decide, shall decide when to hold, when to remove, he should go for future contract. Clear? Any questions? Okay. Let's look at a quick example of a forward contract. Okay. An investor enters into a cash settled forward contract to buy 100 ounces of gold. So the amount is fixed. The forward price also is fixed. He's going to buy it at 1,792 per ounce. The time period also is fixed. So quantity is fixed, rate is fixed, and the time period. Today's price is so much. Right? So obviously he is going to buy at a higher price because obviously he knows the price will go up. So he agreed to buy only $22 more. Fair enough. But when he went to actually buy on maturity, what happened? The gold price went up only by $10. Right? Right or wrong? So you have a forward contract for so much, this so much. You have an actual price for so much. They are saying find the forward price. What's the forward price in this equation? What's the forward price? Easy to note. Is exactly what we have potentially picked up, right? 1792. Spot price 1770. Contract maturity is 1780. Right? After 3 months. So effectively, how much is the amount that he's going to pay off or rather settle for, right? Now, if you look at this quickly show the example, right? Today it's 1780, today it's 1770, but honestly, this is pretty much useless. I don't need it. In the future, I agree to buy it at 1790, 92. But the price on the date the contract ended is 1780.50. Correct? So when I agree to buy 792 and it's actually 1780, that means I have a loss of 11.5 per ounce. Correct? The gold price, what you agree to buy, you're paying more. You agree to buy it at 1792, but the price is only 780. So you have a loss which you're going to pay of $11.5. But don't forget only 100 ounces. So it's the amount that you're going to incur as a loss is 11.5 per ounce into 100, which is 115. Clear the logic? So you remember this is useless. You agreed at this price. The price is actually so much. The difference is what you are responsible to pay, or you pay the full money and pay the full amount. But this is the amount of loss that you have to incur today by way of doing the contract. Yeah, 1792, 1780, and therefore you end up with a loss of so much based on the 11.60. Now, let's see, let me give you guys one exercise. I want all of you to match the number, match the following. First, start. What does the forward contract purchaser seek to do? He purchased the forward contract, right? So he's long. He went long. What are you doing? He's trying to seek benefit from underlying price depreciation? No. He's buying. So he's trying to benefit from appreciation, right? He will again the initial spot price is more, or he receive a positive damage of spot price exceeds the forward price. So he agreed to purchase at a certain forward price. If the spot price goes up, he agreed for cheap, right? So he will surely get a positive payoff if he has agreed for a cheaper price. Yeah. For that to happen, the spot price should go up. Okay. Who is the forward contract seller? What does he do? Now, obviously, your purchaser is trying to benefit from an appreciation. A seller will try to. Okay. Now, you are given the initial spot price exceeds the forward price. Seeks going for underlying price depreciation. What's the answer? Neither forward. Clear? Okay. Purchaser wants appreciation and therefore he will earn maturity. Seller wants depreciation and therefore he will earn a maturity if the price is sold at actually falls the market, he has the right to sell a higher price. Right? Neither forward purchaser nor seller will realize any gain if the initial spot price is exceeding. तो उसको फर्क ही नहीं पड़ेगा, right? Because he will not earn anything on day 1. He will earn on day 30 or day 60 or day 90. So remember guys, these guys have 0. On day 0, effectively, he'll have nothing. On day 0. No profit, no loss. You got the concept, answer the markings carefully. Any doubts? No doubts? Okay.
Sir, can you explain part C?
So part C, so basically you're saying, see, now neither forward nor purchase nor seller is fine. Now, if you correct this, realize the gain if the initial spot price exceeds the forward price. Now, when you enter into a forward contract on day 0, right, you are obviously going to enter into a forward contract where the forward price is going to be either greater than or it might be less than the spot price. It's going to be, right? That's in your forward contract. So just because the price is greater than less than, it does not mean that you will realize a gain or loss. There is no gain or no loss on the date of the contract. That's why you're saying neither of them will make a gain or loss on the date of the contract. Here. On the contract date, no profit, no loss. On the maturity date, they will book their profit or loss by looking at the market price. Got it? So today there's no point looking at this price. It's only on the date of maturity when the stock price is out. Clear? No questions anymore? Understood that answer? Now, suppose you can put, like I already told you before, that the person who's buying is called long, the person who's selling is called short. So in the exam, they may tell you, they won't say buy, sell, they say long and short. So तुझे जाना चाहिए long खरीद रहा है, short बेच रहा है. Who is a forward contract? Someone who has a risk, not someone who's going to take a risk. Risk clearly अभी बोले अभी मिटके में कैसे करूँ? अच्छा, forward करेंगे. How to get the benefit future contracts? So they're taking a risk and then they mitigate it. Okay, and I told you sometimes you do one-to-one or sometimes you offer middlemen or dealers. Who are the dealers? All the JP Morgan, Morgan Stanleys, things like that, right? All the dealers are going to sit and create a fund around it and then get. Clear? So remember the long wants to hedge against the appreciation. तो पहले slide में देखा. The short wants to hedge against the price depreciation. Yeah, long and short. Okay, so types of portions taken, very important to make sure that you understand those portions. Now, so far we've done only forward contract. We said commitment hai, karna hi hai, you have to give the goods, pay them, take the cash and so on. Now it is possible that instead of sitting and saying, boss, you pay me full cash, I'll pay you shares. You can simply decide to do it based on net settlement. Net settlement. You can see how much the market price is here and put it. For the net settlement is when you are settling it in cash. That is exactly what a futures contract does. They will settle the amount in cash by looking at the differential. That's it. Okay. So obviously future contracts, you know, they're standardized, right? They're all standardized contracts for the future. Defined amount, defined period, defined rates, and so on. Right? They're backed by a clearinghouse, obviously. Okay. Obviously, they're backed by the clearinghouse. Make sure that these contracts are settled, are cleared, are not cleared, are written off, and so on. Okay. Election as a clearinghouse, it can be treated on others, and that's that. Okay. So here I'm talking about futures where there is absolutely no leeway. They will settle it mostly in cash because that's what futures are for. Okay, I will quick look at this example. Right, so are we clear futures also now? Forwards, futures, right? Now we'll apply the same concepts that we did in the earlier part. We'll try to value something by looking at broadly zero arbitrage, right? Now you know future contract on the day one is going to be value at market price. So हो ही नहीं सकता, so they'll have no value on day one because the entire amount is considered in that aspect valuation. Future contracts are marked daily, so रोज का profit and loss, रोज का will be given to them or reduced from them. So they keep accruing that every day, right? The value of future contract values is zero only during the trading hours between the times at which the account is marked to market. So when you're marked to market, obviously say, oh, मेरे पास value है 100 का, but market is showing 120, right? I'm losing 20 maybe, so I will put 20 and market that. Yeah, mark to market. Now, what is the value of future contract? Very simple. What's the current year's price? Future's price minus the 2. Yeah. Broad answer to the value. If the future price increases, the value of long increases. Obviously, we know that. So, if future price बढ़ा, so value बढ़ेगा. My mark to market will also go up. If the future price decreases, then long will suffer and short will benefit. Yeah. So please learn the valuation well because in valuation I'm looking at applying current future price, right? Minus the previous market price. Yeah. Any questions? So Future contract is more valuable and it's based on the amount of time left and the uncertainty because of which the value may go up. Clear? So quick recap between forwards and futures. Very important. Please learn this very well. Forwards are not regulated or limited, but futures are properly regulated. Exchange traded, OTC, ETC, OTC, right? Default risk is there, you're not there. Margin is not required in forward because there's no mark to market. So remember, mark to market has happened, then there's no need of it. Oh, they didn't mention that. There's no mark to market. अगर mark to market होता ही नहीं है, तो margin भी नहीं चाहिए, और default risk भी हो सकता है, right? यहाँ पे there is a mark to market model. If mark to market happens, that means I'm guaranteed margin, standard, and so on. Clear? This is my mark to market model. And the others are obviously that you know, example, default risk, credit risk, to the other aspects of the same. Okay, that is my main difference between forward and future. Now, let's come to the second main difference between a forward and a future. Main difference. In a future, you are supposed to maintain, give a initial margin. So let's say I entered into a, let's give a different example, let's say Infi future, right? Now there will always be a certain number of shares. So let's say I did 100 shares. And the value of Infosys is how much? Let's say 1600. Okay. So that means you are going to receive, right? The amount if it goes up or if it goes down. Correct? So right now dealing the price of 16,000. Correct? Now remember, the value that you agree to buy it at is 16,000. You will have to put some down payment today because you may disappear. Even this guy. So you need to put down a down payment, both him and this guy, which will allow, okay, the down payment will allow the trade to be executed. And here you're paying nothing but initial margin. So let's say I'm putting a margin of, let's say, 500. Okay. Now 16. Here. Infosys. So 1600 means 1.6 lakhs per year, right? Now I am saying that I have 500 for Infosys, right? I'm also saying I have certain number of shares. So as I keep increasing, I need to put a certain margin that will take care of this amount. So my margin might, for all you know, might be 20,000, right? If I put a margin, whatever profit loss is there will be adjusted from margin. This margin is called initial margin. Okay. Initial margin Q, because this margin is to protect 6 lakhs and this margin we utilize for all the losses. Let's say 20,000 ka tune 50,000 book kiya, right? Or 120 book kar diya. Okay. Then if the margin falls, let's say margin became now 8,000 because you book losses. Then they'll say, boss, I want you to give me more margin, and that is called variation margin. Means I'm varying my margin amount to a higher amount. But this you will do only when the margin falls below the minimum maintenance. Matlab say maintain 9,000. You are supposed to maintain 9,000, you didn't maintain. Correct? That is called maintenance margin. Maintenance margin. Clear? And maintain margin nothing but the amount you maintain. Below that it goes, it will trigger a call which is called as variation margin. Clear? Okay. Now see, that's this term here, variation margin. Whenever you're called upon to make a payment to this, you have to actually consider having the variation margin. Okay. Any questions on this? Good points. Okay. Future prices and spot price, you know, this is exactly similar to earlier module. Like the future price equals spot price, but if it's including interest rate, it will work out. Okay, spot price is always a reflection of the spot market price and where it might be the future, right? Now the futures price will always converge to spot price. It will converge because the price is also smaller. Okay, and an expression, the settlement price equals spot price. And expression say, boss, okay, now agreed. Now let's come to the agreed price. This agreed price and settlement price also refer to as spot price. So you are going to effectively look at my agreed price, market price, combine the two, and then decide which is higher and based on that. Clear? So you remember settlement price, spot price. Very good. You're saying something? Understood? Okay. So settlement price, spot price, futures price, and finally expiration price. Yeah. Now, what exactly is mark market? I already tried to explain to you. For example, let's say I work contract for 2.5 and the contract price goes about 2.5, then it's called limit up. मतलब limit के बाहर गया, limit के ऊपर गया तो limit up, limit के नीचे गया तो limit down. So I do have stuff based on that, but I need to look at what's the amount involved. They're saying no trade will take place. Okay, because lock limit. Obviously, if the limit go lock ho gaya, so you can't do much. Correct? They say can't be taking place. And the exchange imposes price limits within which you can do it. So you have to ensure that your price is somewhere more than this and this than this. Yeah. You know, you come to the part where this is called mark to market. I'm trying to mark my position on a daily basis and pay that amount. Okay, mark to market. Now we have done the earlier example, same way they're showing this, that if you enter the futures for 1792 and the market price is 7080 on expiry, how will you deal with it? Obviously, you have to ensure that you have picked up the right number and values. Okay, program is paying so much. See, margin account is 5450. Okay, so don't worry, you may not find a perfect mix between the two always, but you have to have some mix and relationship. Okay. It's an interesting one to show you how mark to market happens. Now, when I say mark to market, this is my daily gains or loss, Rojpa. Okay, and that's my margin balance. I have decided that at this price, I will be able to consider that 1792. Any questions? So this is what I agreed effectively. And based on this, I have maintained a balance so much. Now later, this guy says it's increased, right? So he has to now pay more amount here. Correct? Later it further increases, decreases. So therefore much more amounts here. Correct? Then 82, 37, 79. So this is gradually going down, right? But then these two are finding out certain variable needs, right? So you see the total gain or loss is not important. The margin balance, you started with 4950, it increased, then it decreased, decreased further. You are allowed to consider, you're allowed to consider based on that. Okay. And obviously margin call. See now, your margin should have been around so much, it went much lower first time. So therefore the answers are good. Shall we move on to swap now? Now in a swap, right, you're swapping the two instruments, right? This is nothing but we're trying to swap your amount or rate or other benefit to someone else who will be more than willing to use them accordingly. Yep. Okay. So this obviously is when you're doing periodic payments. Quick example, let's say A is earning, A earns 7% on FD and B wants 7%. Okay. He's saying, boss, give me 7%. He is willing to give of fixed rate. And this guy picture wants fixed rate. He said, ठीक है, एक काम करते हैं, you pay me, okay, fixed rate. So A and B will enter into a swap and say, let me give you my rate, you give me your rate. So what is already earning and what is already paying, they will swap the two, and effectively A will tell B, भाई तू मेरे बेhalf पे collect कर लेना, and B will say, ठीक है, मेरा भी तूने मेरे behalf पे pay कर. Yeah. So these are instruments. Obviously, if you customize instruments, you can get a series of formulas. Yeah. Okay. So this is just a bit of theory. Okay. But in a swap, remember, there will be periodic payments. There will not be a one-time swap. You'll have to swap it over the period and then give them the payment history. Yeah. Okay. Now in swaps, we normally have the most popular one is called the plain vanilla interest rate swap. Now the plain vanilla interest swap basically refers to a simple plain interest rate swap जहाँ पे interest is being swapped every quarter or every period, right? Now look at the example here. ये swap है. I've agreed to swap my floating rate for fixed rate, right? Floating rate to a fixed rate. That's called a swap. Okay. Now here they're saying for 6 months. Here is 5 years, but the amount is 200 million pounds. Yeah. So here I'm actually doing a swap where, see, look at this, 180 means after 6 months, after 1 year, after 270 days. So here I'm not even clear, sure what exactly is happening on the inside. Okay. And you notice that because that's fixed, they are divided by 2. But you don't have much of a choice. Yeah. So this is a plain vanilla interest rate. So please understand, guys, the principal amount does not change money. I am saying my reference point is 200 million pounds. I will pay interest on 200 million, you pay me interest on 200 million, but I will not allow him or me to touch the underlying book. That's more critical. Yeah. That's how you take the risk. Okay. When I give interest rate, obviously remember it is always normally by 2, but you have to be careful about the patterns. Okay. Now you guys take a minute if you understood, and we'll do it properly. Take a minute to answer, take your time and answer which of these, or how the interest swap goes, and what is the amount of cash flow that will exchange every quarter. So no, every quarter we're going to affect the cash flow, right? Every quarter, how much is the amount that we received and paid? Answer, take your time, draw the timeline. What they're saying, fire contract, receiving $200 million interest rate. Receive fixed 200 million interest is for the financial instrument to increase the duration. Under term swap, by Filton has agreed to receive a fixed rate of 2.5 and pay MRR of whatever. Now remember, the MRR is a rate. It's not given. अगर दिया ही नहीं तो तुम उसको पैदा नहीं कर सकते. You have to do it based on what's given to the exam. They'll tell you later that MRR is fixed for 1.9%, right? So that's one more broadly. Okay, MRR is the rate. So you have to find out what is the cash flow hedge for the exchange year, and then based on it, we're going to follow. Right? 5-year fixed with the current intermediaries. Now, they're telling you that for the first swap, I'm giving you the information. Exchange is 1.95. So today, पता चला यार 1.95 था. And how much are you trying to do? You're saying I want to receive 2.25 and I'll pay. So you are going to receive 2.25 and you're going to pay how much? 6 months MRR 1.95. Correct? Okay. So obviously this guy will receive 1.95, right? He'll receive based on that, and he'll pay the other amount. Okay. Now, what is a cash flow swap cash flow exchange? Simple. Find out that after 6 months, how much is that he has to receive and pay based on the details. Okay. So I go to cash flow is set for 1.95. So go on. Who do you think can be the numbers for this? So here I'm paying 6 months. Okay, every 6 months. So what's the flow in that? Okay, go on, start. So here you have the concept of financial intermediary, where you owes some amount to the people, and he owes a financial intermediary also some amount, and the banks are all fine. Okay. So you have to ensure that the cash flow is not impacted and the cash flow is continuously coming to the top. Okay, fine. Okay. So this is interest rate swap. You have to understand interest rate swap. Which one is being swapped? Here the interest rates are being swapped. So therefore the amount as per the books are also different. Here, so interest rate swaps, I'm swapping, and remember it normally happens every 3 months because interest rate is set back every 3 months, right? Now, using interest rate swap, you guys think what is the answer? Using concept interest rate swap. Now remember in the interest rate swap, we have a fixed rate and a floating rate. One person will pay fixed and receive floating. The other person will pay floating and receive fixed. So what does fixed rate payer do? Does he make a payment based on market interest rate? Market interest rate is floating rate. Who will pay market interest rate? The floating rate. Who will pay a fixed rate? May face a positive to negative mark to market over the life of an interest. Both. Now we have fixed rate and floating. You know there are two pairs. One is paying fixed and one other is paying floating, receiving fixed. One is paying fixed rate, right, and receiving floating, and the other fellow is paying the floating rate and receiving fixed. So both of them, is it may face a positive negative mark to market over the life of an interest rate swap contract, or do they receive a net payment on the swap for any interest period for the market reference rate exceeds the fixed rate? So here I'm saying the market rate exceeds the fixed rate. Market rate is greater than the fixed rate. So if he's right, and he's saying receives a net payment on the swap for which the market reference rate is greater. So when we receive a net payment, when he's paying a fixed rate and the market rate is greater, then he'll receive a what? A net payment. So fixed rate payment guy will make money when the market rate is higher. Correct? And therefore both of them may face a positive and negative mark to market over the life. Clear? Okay. So fixed rate will benefit from the market rate going higher. Floating rate will benefit from the market rate basically going lower. All right. Any questions? These are good examples of match the columns, but very good illustrations that way. Yeah. Good. You got the answers right. Well done. Okay. And now we've done futures. We've done forwards. We've done interest rate swaps. Now we'll come to options. Options is a beast. There's a lot to do in options. Clear? Let's come to it. Let's just quickly, quick 5 minutes. Now we're going to just have a cup of water. Use the washroom. Now more than 3-4 minutes. Let's reconvene and we'll start options. Right. So let's start options. Okay. Now options is very different from forwards, futures, and even swaps, right? That's why I wanted to make sure that we do this separately and you understand the key difference and understand the terminologies here. That's very important. Okay. Now let's start with the main concept, option. Now in an option, like in a forward or future, you have no choice. You have to go ahead with the price. If I decide that I have to buy Reliance at 1500 after 3 months, I have to buy at 1500. I don't have a choice to back out. I cannot back out from the deal. But in an option contract, you have the right to back out of the deal. If you buy an option to buy Reliance at 1500, and if the market price becomes 14, you can say, boss, sorry, I won't buy from you. I'll go to the market and buy, because you bought an option. So the option buyer has the right to either continue the deal or back out of the deal. But the option seller does not have any such right, or this. He has only an obligation. Okay. So let's understand the meaning. The person who buys an option is the long. Okay, now remember, long is not buying the shares, underline. So the person who is long of an option, this guy being long, he has the right. Now, what is the right he has? The right that he has can be either to buy the underline, or he has the right to sell the underline. But he has the right. That is important way to understand. Right here, Oscar. That right could deal with buying or selling. Correct? If tomorrow he feels that no, it's not worth buying or it's not worth selling, he can back out. Why? Because he is long. And long is nothing but the fellow who has purchased the contract. Correct? If this guy has the right, who has the obligation? The fellow who is short. The one who's short has the obligation to see through the deal. He has the obligation to satisfy the long. If the long says, no, I want to buy, this guy has no choice but to sell. If the long says, I want to sell, he has the obligation to buy. So if this guy opposite is this guy, he will buy, he will sell. His right will be matched by his obligation. If he decides not to buy, this guy will say, fine, no problem, I'll not sell. But he is at the mercy of this guy's choices. Why? Because he's long and he's short. Now you wonder, wow, so much power is into this guy. That's amazing, right? Don't worry, this comes at a cost. This guy who went long and has a right, he pays a cost for the right, and that is called as a premium. He is paying a premium of whatever amount towards having the right. This premium is received by this guy. This guy receives a small premium of whatever amount, and because he received the premium, he already earned the income, he will satisfy the obligation. This guy is going to pay the premium and will enjoy the right. Are we clear? So in an option, I have a long, who's the buyer, and I have a short, who's the seller. The buyer has the right, the seller has the obligation. Are we clear? Now I also told you that his right could be to buy something, and when he has the right to buy something, that's called a call. So he's saying, I want to buy something, I'm calling it. If he has the right to sell something, that something sell is called a put. So when I say someone has a long call, it means he has the right to buy. If I say he has a long put, it means long means right and put means sell. So right to call, right to put, right to buy, right to sell. Long call, long put, right to buy, right to sell. This is the contract. Now in life, when you ever do an option sum, always do it from the long point of view. The short is always going to be satisfying the long. So if the long is going to make 50 rupees, the short is going to lose 50. Whatever the long is going to make, the short is going to lose, you turn minus sign. That's it. Clear? Obviously, premium. The long is going to pay premium, so he's losing 50. This guy is receiving premium, so he's gaining 15. So remember, the game is a zero-sum game. What he makes is what he loses. What he loses is what he makes. That's it. Are we clear? Okay. So we learn the concept of call and put, rights and obligations. And options are also exercisable when. Now learn this carefully. European option hai, so you can exercise it only on expiry. You can say, boss, when it expires, I can exercise. I can't do anything. But American can be exercised anytime. If I want to sell the option before the due date, I can sell American option. Correct? Now, obviously, options are traded on exchange. So you don't have to go and find the guy from whom you bought and sold. You can just go to exchange and buy it, sell it, or buy it. You will get your best price. Yeah. So European only at maturity, American only. Sorry, rather anytime you want to sell or buy it. Yeah. Obviously, therefore, American options are much more valuable because you have the right to buy and sell them whenever you wish. Correct? Now, this is very interesting. This is a nice diagram which will help you understand how the people make a profit or loss on maturity or expiration of an option. Clear? We go into diagram. Let's understand. Okay, I'll say some key terms. What is P off? P off is nothing but the amount paid at maturity. Correct? That's called payoff. Okay? And profit word means the payoff you received, but don't forget you paid a premium at the start of the option contract. So when I bought the option, right, on day 0, I paid premium. So premium is a sunk cost. I paid premium. But on day 30, let's say maturity, I am going to get a payoff. Now remember, payoff will always be positive or 0 because I'll never lose. So what are premium minus payoff? Now the payoff minus premium, what is the net amount? That net amount is called as the net profit. So in the exam, they say compute the profit. You have to find the payoff and the premium and minus. If they say compute the payoff, do not minus the premium. Is that clear? Okay. Now you understand payoff will always be positive. We always told you because you have the right. So therefore, the payoff formula is what is the maximum of 0 or this? If this answer is negative, then the answer will be 0 because you can never make a loss. So let's understand the call option. This is call. Now what is call? Call option means the right, I'm looking at long point of view, the right to buy. Correct? Now if you're buying, you will profit when the market price goes up. Correct? Now what does X stands for? X stands for the exercise price. It means that I have the right to buy at 40. So I can exercise at 40. Correct? I'm paying a premium. C0 means the premium. I'm paying a cost of $5. Clear? Now, if I have the right to buy at 40, that means obviously till it becomes 40, I'll do nothing because it's an option, I'll do nothing. But when it becomes 40, I'll start exercising my right. Correct? So it goes like this. From 0 till 40, I will earn no payoff. After 40, I'll start earning money. Like this $5. So after 40, at 45, I'll earn 5. 50, I'll earn 10, and so on. I will earn unlimited payoff, right? So till 40, I earn no payoff. But understand one thing, at 40, I earn no payoff, but I still lost $5. So when will I earn no profit? At 45, because here I earned $5, but I have to pay my premium. So if I draw a profit diagram, it will look like this. I lost $5 till 40. At 41, I lost only $4, $3, $2, $1, and at this I lost $0. And after this point, I will make money. I'll make 1, 2, 3. So this is my profit, and this is my payoff diagram. Is that clear? Now, what I'm going to understand is this: payoff becomes positive after 40, but profit becomes positive after 45. Why 45? Because 45 is nothing but 40 plus a premium. This is a very important formula. You will break even at a point where the share price will go above the exercise price and the premium. This formula is important. And was a X price 40, and it's proved कि भाई 45 के ऊपर ही तो ये profit है, 45 is break-even point. So if you have another sum, let's say excess price is 60 and premium is $3, you say fine, 63. Simple. Clear? So, and again I say this for long. Whatever the long is doing, the short is doing the ulta. Long lost $5, the short made $5. Right? Long went up from here, short went down from here. Long is unlimited, short is unlimited losses, long is unlimited profit. Simple. This is how you interpret a option diagram for call. Because call is to buy. So when you're buying, you want the price to go up so that you are benefited at a cheaper price. Clear? But when you're selling, you are benefited at a lower price because you're selling high and the price should fall. Clear? So buying ke liye everyone's clear. Long call, short call, and the payoff and the profit diagram. Clear? I will explain to you this payoff and profit. Please learn this well. Can you guys take a minute to learn this diagram and apply the diagram? That's more critical. So the diagram is very important to understand the concept of break-even point, the payoff positive negative, the payoff chart, vice negative, and so on. Learn that quickly. Make a note, guys, in your books or diagram. Okay. Now, same concept, but the answer and the diagram changes because I'm now looking at a put. Put is the right to sell. So when I want to sell, if I decide to sell something, right, at a price of $40 and I paid $5, this time I want the price to fall to below 40 because I will make money only when the price becomes 30, right? Say I'm selling 40. If the market price is 45, will I sell it? No, I'll say I'll go to market and sell. So here, the market price should be 30, 20, or 10 for me to exercise the price, right or wrong? So only when the market price is falling, so here it will be like this, 40. After 40, I will be making positive payoff. But remember, it will end at the point where it's 40 because when the graph price is 0, you're making only 40 because that's your strike price. It can't go below 0. Can it become negative? No, right? The stock price can't be negative. So when the stock price becomes 0, you're earning 40, right? But the profit is actually not at 40. It's at 35 because when it becomes 35, you made $5, but you also lost $5. So at 35 is a breaking point, and when it becomes 0, you are earning 35. How I got 35? Same funda. Stock price, but this time minus 5. So 40 minus 5 is 35, and this is your break-even point. So in a call, you realize the break-in point was 40 plus 5. But in a put, it is 40 minus 5 because here you're making a share price fall. So यहाँ पे minus होगा, but वहाँ पे you make it go up, then be plus. Are we clear this formula? As I told you, break-in point is very important formula. If it is for a put, it is x minus p. If it's for a call, it is x plus c. Clear? Clear? And if it's a long put, you know this concept. And if it's a short put, it will go ulta direction. So long put, you make a profit here. Short put makes the loss here. Okay. You lost premium, you will always lose it till it falls below 40. This guy is always making the premium till it falls below 40. Here, same formula. Payoff is what? The difference between the stock exchange price only till it's positive. Here, profit is again same. Payoff minus the premium. Here, so call and put have completely different diagrams. Are we clear then? Now, time for you to apply your thoughts and tell me what is the answer here. What is the seller maximum profit and what is the maximum loss under contract? Now, this is from a seller point of view. So you do one thing, you think of the buyer, no? Leave the seller. Okay, see, option seller receives $5 premium. He will never receive anything more because the option. So can I conclude that the maximum profit is $5? उससे ज़्यादा मिलेगा ही नहीं इसको. That's why it was like this diagram, right? The diagram was like this. Flat. $5 पे cap हो गया. उसके बाद वो नीचे ही करेगा. So $5 is maximum profit. What's the maximum loss? Now he sold it exercise price of $30. 30. That means if it falls below 30, he will lose money. So below 30 can go only till 0, right or wrong? If it goes till 0, okay, then he will lose the full 30, but he already made $5. So he will maximax lose 25. So he is going to max gain 5 and lose 25. Quite a big risk reward ratio, right? It's 1:5. But obviously, even he knows that the share price becoming 0 is very unlikely. Correct? But you do realize that for a put, the short put, the put option seller will always have, please on these points, he has a maximum profit and a maximum loss. You cannot say he has unlimited loss. The short put will have limited loss and limited. So both profit and loss are limited for the short. Obviously, theoretically. Are we clear, guys? Theoretically, both of them have a cap on the profit or the loss that they're making. Any questions? Clear that? Okay. There you go. That's the solution. Maximum profit, $5. Maximum loss, 25. Diagram, just showed it to you. I could ask you one more thing. What's the break-in point? What's the break-in point? The break-in point, remember the formula, X minus premium. So here the answer will also be $25. You will be surprised. The answer for the break-in point and the maximum loss are the same. Obviously, break-in point is market price $25. He'll break even. वहां से तो zero ही होगा ना. So he will also lose 25. Correct? So the answer is 25 for break-in point. Clear? Okay, so let's come back to our match the columns. What's the answer here? Guys, I'm getting no response from you. It's going to one-sided. Can you take a minute? and answer this question. Come on, answer. What's the answer? Put option seller. Now remember, seller has the obligation, right? Obligation. So the seller is seller. But put means the right to sell, right? Now the seller has the obligation to satisfy the put. So put option seller. Put means the right to sell. So this guy will have to buy, correct? Put is to sell, but from a long point of view. But to a seller, it is an obligation to buy. Call option seller. He sold the call, right? He sold the right to buy. So this guy has the obligation to sell. Clear? Let's see the numbers. If he has an obligation to buy, he has no risk, wrong answer. He earns a profit equal to premium if the underlying price is less than the excise price. Now tell me one thing. When will this option contract be useless? Put. When will be useless? When the market price is more than the exercise price. Then it's useless. And this is useless when the market price is less. Because this guy will not want more or less, he wants more. And this guy will want less. So if the market price is less, then it's useless because the market price should go up for him to profit, right? When is that happening? If the underlying price and maturity is less than the excise price, underlying price and maturity is exceed the excise price. So the answer is here, right? Correct? Because the underlying price is more, he earns a premium. Here, call option seller. Underlying market price is less, so the answer is here. Okay, and both of them, option seller and put and call, has no counterparty credit risk to option buyer once the premium. Premium pay ho gaya, he received, he is not bothered because that guy will find him. He has no risk because the seller has already made his money and he is going to pay only when the buyer contacts and says, boss, pay me the amount. So he has no further counterparty risk. Clear? So how to think of it? Think like this. Put here, the market price should be greater. Therefore, they are looking at market price exceeds. Then he's going to make no further money. Right? Because remember, put option will want to exercise when the market price falls. Correct? Above, he will not exercise. Yeah? So please learn the concept carefully. The answer is A, bottom, C up, and B, C. Yeah. Okay. So revise it carefully. Okay. Now we've done future, forwards, swaps, and options, right? Now the last concept for the day, then we'll wrap up our class with this last concept called as credit derivatives. Credit derivatives. Now what is credit derivatives? I would call this effectively, so a CDS, I will call this a simple insurance plan. Like an insurance contract, I can call this an insurance plan. Okay? Because all of you know what an insurance plan is, right? What's an insurance plan? You pay money, a premium to the insurance company, and they will protect, they will obviously not protect, they will give you a payment in the event of death. Right or wrong? Same thing happens in a CDS. You are paying a premium to the company and they will pay you money in the event of death of the credit of the party you're protecting. Death means default or insolvency. So what are you doing? The protection buyer makes a periodic payment like insurance, and in return, the seller is giving you protection against a default. Let's say Vijay Malia, you gave him 1 crore. and you took a CDS. If Vijay Mallya defaults, you pay me money. So kal agar Vijay Mallya defaulted, this CDS would have paid you the money because he defaulted. It is saying I guarantee. So this is like a guarantee program where you're buying guarantee and you're paying premium. Is that clear? And you're buying guarantee against what? Credit default. Against the default of credit of that customer. You are protecting yourself against that. Simple. Protection mil gaya, you're good to go. Clear? Credit default swap. Obviously, a greater probability of default or loss in default means you'll have to pay more. Agar that party is bound to default, then there's a boss, you better pay more premium, right? Right? So there's a greater payment and a wider spread in the event of a greater default. So higher the probability of default, more the premium. Less the probability, less premium. Yep. CDS is a very important instrument that helps you to hedge against credit risk, right? So in summary, the buyer is buying risk, right? And the seller is the one who's selling risk. He wants protection, he wants money. So this guy will pay him the spread or the premium, and this guy is paying him protection. He says, don't worry, if anything happens, I will pay you in the event of a credit default. Here, again, remember, it's only in the event of a credit default, not otherwise. Here, if that guy has defaulted, then you will get the payment. Here, CES. Any questions? All right. So that's what our credit derivatives CDS was. Look at the story it's going to show in terms of summary. Okay. And please learn this well. This is exactly what happened during the 2008 crisis. Okay. Today he will buy protection buyer. Okay. CDS spread 100 BPS, the seller. Okay. Now after one period, when the migration happens, the spread is around so much, buyer will get payment if there is a migration of credit and the seller will have to pay, right? When the credit event happens, the buyer will demand the amount of loss he incurred into notion. So let's say he protected $1 million and he made a loss of 20%. So he will pay him $0.2 million. The loss is the loss amount into the notional. This is what the seller will pay the buyer. Is that clear? Okay. So remember, there's always a notional amount that they are going to deal with. It may not be for the actual amount of loan, but the entire notional amount. So this is how you deal with the payment of LGD, which is loss given default into notional amount, right? If I'm saying a default happens and you lose 20%, usko multiply with the amount of the loan, which is the notional amount, and you get 0.2 million. Clear? So please learn how to also compute the amount of protection and the payment. Clear? Okay, come back to our famous master columns. One guy will tell me what's the answer here. So who will buy protection? The one who transfers the risk of loss to an unlike party. So the buyer is entering a contract to transfer the risk. He's saying, boss, you have risk, right? You take the risk. So the buyer transfers the risk, right? The seller is receiving premium, correct? And both of them are doing what? Think carefully now. The seller is the one who is effectively what? Faces, so the options are seeks to gain from a higher Issuer credit spreads means the issuer, if it has a credit spread, matlab default होने वाला है, correct? If you like to default, that will happen. Is it both or is it the seller? Okay, and faces an MTM gain on the CDS contract if the CDS spread of the underlying issuer falls. The CDS spread is again the amount of default, right? If that falls, then who will make a gain on the CDS contract? Credit protection buyer and the credit protection seller. That's interesting. So because we are saying both, actually no, sorry. So it's both the buyer and the seller. So they both enter into a contract that transfers. So both of them enter into a CD. So I think potentially the answer might be enter into a contract, right? Now, who seeks to gain from a higher issuer credit spread? If the credit spread is very high, then the person will gain when he's buying the contract, and the seller will face the MTM gain on the contract if the CDS spread actually falls potentially. Okay, so they are actually very tricky options. Let me just put it from here. Yeah, okay. So both people I mentioned enter into a contract, correct? Both of them enter into a contract to transfer the loss or gain, right? The buyer is the person who will always gain because if the spread increases, that means default ka chance badega, and who will get the money from default? The buyer. So the buyer will gain if the default increases. When will the seller gain? The seller will gain when the spread falls. Correct? So remember, spread gaya upar, buyer will make money. The spread falls means default nahi hone wala, chance kam hai, so the seller will make money, right? But both the buyer and seller are looking to enter into a contract which will transfer the risk of loss from one party to another party. Clear? So we have two people here, a buyer, a seller. Buyer wants protection from spreads going high. Seller will be happy if the spread is low. Okay? So this is completely like an insurance contract. Clear? So any questions you guys have? Okay, so that's quite heavy duty. So quick recap. We did derivatives, we did forwards, we did futures, right? Forwards are commitments, right? Even this is a commitment, but in a forward, you're doing cash, right? So in a forward, you're doing settlement by delivery. In a future, you are settling by cash, right? Future is traded on the exchange. Forward can be OTC, correct? But both of these are commitments. How to avoid commitment? I'm giving you the world of options where you have a right and not a commitment, correct? And then we have swaps where you can swap one liability for the other. You can swap interest rate, you can swap shares, you can swap payments. These swaps can happen between parties. So there are four types of contracts. And in the end, we did CDS. We're looking at credit default, right? Where you're paying a premium and you're receiving protection, correct? You're paying premium, but you're getting protection against credit default. So we have covered these five types of derivative contracts in detail. Clear? Okay, any questions? So we'll pause there because we've done a very high level, heavy duty drilling into all this. Tomorrow, we'll wrap it up by looking at the broad benefits, obviously some of the risks, and how do the users actually use this. Okay, so please take this time to recap and revise what you've done so far. Go into details of the derivatives, understand what each contract does, understand the options diagram. We did the call option, the put option, because you have the right. So long call, long put, understand the diagrams. One goes like this and the other goes like this. Correct? Understand the diagrams, how they are going in the pull, and try to understand the break-even point. Correct? Where we said one is x minus c and the other is x plus c. Correct? So learn the break-in points, where you break even and how the break-in happens. Correct? And then try to compute those. Okay? We also did the concept of payoff and the concept of profit. Correct? So options are frankly the most tricky parts, where we have many concepts. For which was straightforward amount you have to pay and you get the net amount. Here we did the no arbitrage pricing obviously, and we did the concept of interest rate differential. So a lot of heavy duty stuff. Don't forget it. Recap all of this for the next 1 hour again. We go through it, and tomorrow we'll pick up the next part and we'll wrap up this part of derivatives, benefits and risk and closes. Okay. Any questions, guys? Any questions you guys have? Okay, cool. Okay, so I'll see you guys tomorrow. Take care. All the best. Study well.